Everyone loves NVIDIA right now. The chart is vertical. Every headline screams AI, and it feels like the one stock you simply have to own. But here's the part almost everyone wants to avoid when a stock is loved: valuation. Not because valuation is the only thing that matters, but because valuation is what punishes you when you are late to the party. Back in 1972, investors made that exact mistake with the Nifty 50. They did not lose money because the companies were bad. These were elite businesses. The mistake was believing that a great company automatically meant a great investment at whatever price the crowd was willing to pay. Today, whether you are a raging bull on NVIDIA or a skeptic, you cannot dodge valuation forever. And in this video, I want to show you, with simple napkin math, how you can lose 50% on a market leader, even if the business keeps growing. Quick disclaimer before we go deeper: this is for education only, not financial advice. Do your own research and make your own decisions. So how do we compare then versus now without disappearing into a spreadsheet? Here is the clean way to think about any stock, including NVIDIA. Every stock price is just a bet on a stream of future cash flows. When you pay a high price, you are really saying that you are confident those future cash flows will be big and durable, and you are okay with a lower return in exchange for that confidence. That is it. And in leader eras, investors quietly accept lower and lower future returns because the story feels safer and safer. In 1972, many Nifty 50 names traded at huge premiums to the rest of the market. Why? Because investors believed the growth was stable and the brands were permanent. These were the you can buy them and forget about them stocks. Then inflation picked up, interest rates went higher, the discount rate effectively jumped, and suddenly the market did not want to pay as much for distant growth. The businesses did not have to fall apart for the stocks to fall apart. The valuation regime changed. Let us make that concrete with a napkin example. Imagine a stock trading at 50 times earnings. Roughly, that is an earnings yield of about 2%. If earnings grow very fast, that can still work over time, but you are starting from a low yield. Now imagine the market later decides that a fair multiple is 25 times earnings instead of 50. That is a 50% price drop, even if earnings do not change at all. That gap is multiple compression, and it is the quiet monster behind a lot of legendary crashes. Now you might say, okay, but NVIDIA's growth is insane, so the multiple is justified. Maybe, but justified is not a simple yes or no. The real question is, what growth path, what margin profile, and what competitive landscape are implied by today's price? When a stock is the clear leader, the market usually prices in the upper end of what seems plausible, not the middle. So how do you reverse engineer those implied expectations without building a 20-tab model? Start with 3 levers. Lever 1, revenue growth. What compound growth rate does the market seem to assume for the next 5 years? Lever 2, operating margins. Is the market quietly assuming today's high margins are more or less permanent, or that they drift down over time? Lever 3, duration. How long does the market assume NVIDIA stays dominant before competition, regulation, or new technology erodes pricing power or market share? This is where the 1972 analogy is useful. Back then, investors implicitly assumed the duration of dominance was huge. The leaders were expected to stay on top for a very long time with minimal disruption. In hindsight, some did not. But even the ones that did win in the real economy still saw their stock prices get hammered when the market repriced that duration because the discount rate moved. That is the part people underestimate. You can be right about the business and still be wrong about the stock, simply because you paid too much to be right. So what does discount rate actually mean in plain language? Think of it as how much investors value a dollar of profit in the future compared to a dollar of profit today. When interest rates are low and money is cheap, investors are willing to pay more today for profits far in the future. When rates are higher or inflation feels unstable, investors demand more return for taking risk, and the market pays less for the same future growth story. That is why regime shifts matter so much for market leaders. Now let us plug this back into NVIDIA. NVIDIA is often described as long-duration growth because a big chunk of its expected value comes from years of AI build-out and data center spending ahead. If we stay in a world where growth is prized and capital is easy, high multiples can last longer than most skeptics expect. If we move into a world where capital is scarcer, or AI demand becomes more cyclical, or budgets shift from whatever it costs to let us optimize what we have, the market can decide to pay less for the same future, even if that future still looks pretty bright. A practical way to think about how much perfection is priced in is to ask, what would it actually take for investors to feel disappointed? Not for NVIDIA to blow up, but for it to be great instead of perfect. The stock needs perfection to justify the current price. It is fragile. If it only needs very good, it is sturdier. The Nifty 50 lesson is that leaders often end up priced for perfect. Another tool, watch how the market reacts around earnings. When NVIDIA reports, does the stock move just on beating the official numbers? Or does it move based on beating the whisper numbers everyone is secretly using? Does the stock sell off on beats, followed by flat guidance? That behavior tells you how high the expectation bar really is. When the bar is too high, even good news becomes not good enough. Now let's tackle the big bull argument directly. What if the total addressable market is so huge that today's valuation is actually conservative? That does happen. Transformational technologies create new markets, and early leaders can capture enormous value. But even then, prices can overshoot. The dot-com era built the modern internet. The technology clearly won. A lot of the late-cycle stock prices did not. So what is a sane way to think about all this? Separate 3 timelines in your head. Timeline 1 is the technology timeline, which can run for decades. Timeline 2 is the business cycle timeline, which runs over years and includes booms, pauses, and digestion phases. Timeline 3 is the market valuation timeline, which can swing violently from month to month based on sentiment, interest rates, and narratives. NVIDIA can absolutely be a long-term tech winner, while still being a very volatile stock across the business and valuation timelines. To wrap this up, here's a quick checklist you can use. Question 1. Is the market treating NVIDIA as quality at any price? You can see it when serious valuation questions get laughed off as FUD, or when critics are dismissed as you just do not get it. Question 2. What regime shift would actually matter most here? For valuation, it is the discount rate and the stability of AI spending. Question 3. What are the early signals? Watch earnings revisions, margin trends, and whether the story shifts from unlimited demand to optimization and efficiency. When the narrative changes, the multiple is at risk. In the next episode, we are going to zoom out and talk more about regime shifts because the 1970s were not just a stock story, they were a macro story. And if you want to know whether 1972 is a real warning for 2026, you need to understand which kinds of macro shifts could matter now. Before you click away, drop a comment. What do you think is the biggest risk for NVIDIA from here? Competition, regulation, or expectations simply being too high? Pick one and tell me why. And one last bit of math to make this feel real. Suppose a company grows earnings 20% per year for 5 years. That is roughly 2.5 times earnings growth. If you buy it at 40 times earnings, and the multiple stays at 40, your stock price can roughly track that earnings growth. Great, but if you buy at 40 times, and over time, the multiple drifts down to 25, you give back a big chunk of that gain. You still might be up, but your return is far lower than the business performance. That gap between what the business did and what you earned is the valuation tax you pay for joining the story late.